So you want to buy water rights. Sure, you can afford the headline price. But first, you need to understand one thing that most newcomers miss entirely. In most of the world, water is not like any other commodity. You cannot print more of it, you cannot cheaply ship it across an ocean to where the demand is, and you cannot simply move the supply around without infrastructure that costs more than the water itself is worth. The asset you are buying isn't water. It's a legal claim on a stream, an aquifer, or a reservoir. And the price of that claim has done something over the past 20 years that almost no other commodity has matched. The entry price depends entirely on which jurisdiction you decide to buy in. The cheapest option is a small agricultural water right in the western United States, tied to a single irrigation ditch or a junior well permit on a creek you have likely never heard of. A senior share in a district like the Del Puerto or the Panoche can be picked up for anywhere between $80,000 and $300,000 per share, depending on the seniority of the right and how often it actually delivers in dry years. The mid-sized option is a portfolio of municipal-grade rights, the kind that gets aggregated into Nevada groundwater permits attached to specific parcels, or surface water contracts in Texas's Pecos Basin. Recent transactions for permanent rights of this tier in the lower Pecos and the Edwards Plateau have crossed $20 million to $80 million, depending on seniority and the volume attached. And at the very top, you have full basin-scale portfolios, the kind held by pension funds, agricultural giants, and the handful of private equity firms that have quietly bought up groundwater storage accounts in the Ogallala Aquifer over the last decade. These begin at $500 million and have no fixed ceiling. The 2021 aggregated acquisition of long-term storage tied to roughly 380,000 acre-feet of annual yield by a Canadian pension fund in the American Southwest closed in the vicinity of $1.2 billion once all the senior priority rights, infrastructure rights, and land conveyor rights had been bundled together. But before any of that capital moves, you have to clear one gate that most outsiders never anticipate. Water rights are governed by one of two legal systems, and the difference between them decides whether your purchase is even enforceable. In the western United States, water is allocated under the doctrine of prior appropriation, which means the oldest rights get cut last in a drought and the newest rights get cut first. Every right has a priority date, often written into the deed as a specific year, sometimes as far back as the 1880s. The older your priority date, the more valuable your share of the river becomes during a shortage. In the eastern United States and in most of Europe, water is governed by riparian rights, which means whoever owns the land next to the source has a reasonable claim to use it, subject to not harming downstream users. Each system has a different court, a different filing procedure, and a different transfer cost. In a prior appropriation state like Colorado or New Mexico, filing a change of use application with the state engineer costs between $25,000 and $150,000, takes 18 to 36 months to clear, and may require you to prove that no other downstream right holder is being harmed by your new diversion. That is the gate. You do not own a water right just because you paid for one. You only own it once the engineer signs the change of use paperwork. The mechanism that creates the value of an agricultural water right is one of the simplest market phenomena in modern commodities, and almost nobody outside the industry understands it. For most of the 20th century, an acre-foot of water in West Texas, the standard unit for agricultural rights accounting, traded between $30 and $80 per acre-foot, primarily because agricultural districts held most of the rights and most of the willing buyers were also farmers. Between 2010 and 2025, that same acre-foot, in the same river basins, under the same priority doctrine, traded above $2,000 in some Pecos auctions and below $400 in others, depending entirely on who the buyer was. When oil and gas operators entered the bidding to supply fracking crews in the Permian Basin, the price for industrial-grade water in those counties doubled within 18 months. when a cloud computing hyperscaler announced a major facility near a West Texas aquifer. The same rights held by the adjacent ranch doubled in appraised value within 5 years. The asset was identical. The neighboring farmers hadn't changed. The only thing that changed was who was competing to buy. The first source of revenue from your new portfolio is agricultural leasing. You sell temporary fallowing credits to almond growers, pistachio farmers, and rice producers who cannot get enough surface water during a low snowpack year. In California's Central Valley in 2024, a single fallowing lease paid $1,400 per acre-foot, with some landowners quietly booking 30,000 acre-feet in a single transaction. The second source is permanent transfer to municipal and industrial buyers. When the city of Mesa, Arizona needed an additional 12,000 acre-feet per year to support new semiconductor fabs being built nearby, the city paid retired farmers in the surrounding districts an average of $3,200 per acre-foot for the permanent transfer. The farmers who had held those rights since the 1960s walked away with retirement funds that the land value alone would never have given them. The third source is industrial sale to data centers, hydrogen facilities, and crypto mining operations, which consume large volumes of water for cooling and electrolysis. The fourth is banking, in the literal sense. You file a water right into a state-managed groundwater banking account. The state credits your account. You then sell those banked credits to any developer or utility that needs the paper to satisfy a new consumptive use permit. The credits are not water. They are not pipes. They are intangible legal claims that the state recognizes as a deliverable asset, and the buyer pays the same price they would pay for a real diversion right, because in many Western states, the banked credit legally stands in place of one. Officially, there are two ways to make money from a water right. You use the water, or you lease the water. Unofficially, there is a third: speculation. The largest buyers entering the Western water market over the last 5 years are not farmers, not cities, not industrial users. They are hedge funds and pension managers who have modeled climate-driven scarcity directly into their projections. They buy the senior rights, leave them idle in storage, and wait for the next drought year. When drought arrives, junior rights get curtailed, the only available water is held by senior claimants, and the price per acre-foot bid at the temporary transfer auction reflects the new scarcity premium. The hedge funds sell their senior paper into that squeeze and exit the position. The transaction closes, the farmers return to fallowing their fields, and the fund books a return that bears no resemblance to the operating profit of a real farm. And then comes the cost side, which is where the math quietly kills the unprepared buyer. Holding a water right is almost costless in years with adequate precipitation. In dry years, the carrying costs accumulate fast. A small district share sitting unused incurs annual district assessments of $250 to $1,500, even if no water is actually delivered. Storage fees in a state-managed aquifer bank run between $15 and $40 per acre-foot per year, whether or not your account receives fresh recharge. Legal costs for actively managing a right through the state engineer, monitoring diversions, refiling change-of-use applications, and defending against curtailment notices can reach $400,000 a year for a large portfolio. The break-even line for a permanent position is therefore not zero, but somewhere between $50 and $200 per acre-foot per year, depending entirely on what it costs you to keep the right in good standing. Two real-world stories show exactly what happens when this business is treated carelessly. The first is the Aral Sea. By 1989, Soviet planners had diverted so much water from the two feeding rivers into cotton irrigation that the lake had shrunk to roughly a quarter of its 1960 volume. The fishing towns around it were stranded 40 miles from the new shoreline. The cotton harvest that justified the diversion lasted another 15 years and then collapsed once the soil salinated and the irrigation infrastructure failed. The water rights existed on paper. The infrastructure that delivered them collapsed. The second story is Lake Mead, the reservoir behind Hoover Dam and the sole water source for Las Vegas and roughly 25 million people across 3 states and Mexico. Between 2000 and 2025, the lake lost approximately 150 feet of elevation. Senior water rights on the Colorado River have been voluntarily curtailed multiple times since 2007. In 2022, the federal government declared the first ever shortage on the lower Colorado system, which meant senior rights in Arizona and Nevada were formally reduced for the first time in the system's 100-year history. The water in those rights was real. The legal claim to it was senior. The river just didn't have it to deliver. Time to pull it all together and answer the actual question. How much do you make if you do this right? 3 scenarios based on real 2025 and early 2026 transaction prices. Option 1. A small Western District share bought at $200,000. Your annual lease revenue in a normal hydrology year runs between $5,000 and $15,000. In a drought year, the same share leases for $80,000 to $140,000 as a senior claim. Payback on the original cost runs 10 to 15 years at normal yields, or inside a single dry year if you time the sale correctly. Option 2. A mid-sized Pecos or Mesa area municipal-grade portfolio bought at $60 million. Annual revenue from a combination of industrial leases, fallowing contracts, and permanent transfer activity runs $4 million to $7 million, with capital appreciation doing most of the work behind it. The same portfolio was transacting between $25 million and $35 million in 2018. Payback in operating cash is 12 to 15 years, and you do not actually need the operating cash because the resale multiple is the real return. Option 3. A basin-scale portfolio such as the major Ogallala aggregated positions trading today at $1 billion. Annual operating revenue from a mix of leases, banking credits, and industrial contracts runs $35 million to $70 million. There is no clean payback in pure cash terms. You are buying a 30-year scarcity hedge against a basin that is literally losing volume every year. The portfolio increases in value because everything around it decreases. And this is why, in late 2025, when the T. Boone Pickens Mesa Vista Ranch and his water portfolio simultaneously came to market, both the land and the underlying rights were treated as separate listings by the broker. The ranch itself, 65,000 acres of West Texas prairie, closed at $250 million. The water rights attached to it took another 6 months to clear, and most of the senior appraisal came in separately, as if it were a sovereign bond. Pickens did not put the land into mineral rights to drill it. He put it into water rights to wait for the sky to break. By the time the sky did break, the rights under his ranch were worth more than the ranch, the crops, the cattle, and the oil leases combined. In every other commodity market, you buy the asset and the asset delivers. In water, you buy the asset and the sky decides when it delivers. The owner who survives is the one who learns to wait longer than the river drops.